In this lecture we are going to be looking at a trade example in the Australian dollar 4-hour timeframe. This is a rather different example because it involves a situation in which a news event took place in the chart. This is something that usually confuses most traders, especially the ones who are not aware of how market manipulations occur in real life. I usually say that news events only add fuel to the fire of price action in a way. That means that we can usually arrive at useful conclusions just by looking at price action under a technical light instead of worrying about what news events mean. In fact, market manipulations and news events often mix themselves together, and in this example, you will see a pretty clear example of how that can happen in the chart. You will also notice how you don't even need to know what type of news occurred to have a good idea of what the market is going to do. This might seem overly optimistic and even naive, but there is a simple reason it is true. The market is not ruled by large traders nor news events. It's ruled by masses of people reacting to those events, and the way people react to these things is pretty much always the same. In other words, if we understand the market logic sustained by human emotion, one can argue that we can bypass the study of fundamental analysis completely. The market manipulation that we are going to be looking at in this lecture is somewhat different from the other manipulations we already seen because it reduces itself to a single focal point. In other words, it's much quicker and more violent than the other examples. The whole market manipulation revolves around one single candle with an unexpected formation. This has some advantages and some disadvantages, as you will see. As you can observe in the chart, price was making higher highs and higher lows in what appears to be the major fractal. As it is naturally expected, there are always stop orders in the obvious market extremes like the last highs or lows. These orders are placed by the common breakout retail traders, which base themselves in this rather primitive and intuitive way of trading. As we already know, this poses a huge opportunity for large traders. The interesting thing about this example is that the news event that took place served as an unexpected twist to the way the market manipulation began. Once again, the market was creating higher highs and higher lows from number 0 to number 3. The most obvious conclusion anyone can derive from that is that price is going to continue rising. Breakout retail traders, however, make a more dangerous assumption. They simply assume that the last previous high is a good place to go long. We already went over the rationale for this type of thinking in other examples, and we concluded that the problem with this lies in the trade location aspect of trading in such a way. For example, imagine that retail breakout traders intended to go long when price broke high number 1 to the upside. The direction they chose was correct, but look at the trade location. In other words, look at how far away they would be from low number 2, which was the actual reversal point of the market. This is how you can be correct about the direction of the market, but you can be absolutely mistaken about where you are opening trades. The natural conclusion here is that it's not enough to be correct about the direction of the market. You need to be correct about trade location and timing as well. As I already mentioned a few times here, the odd thing about this example is that the tridimensional axis of the manipulation happens too quickly, and this can be a challenge in real time if you are not careful. Let's take a deep look at what happened in candlestick number 5. Right around number 4, the retail breakout traders are preparing themselves to go long if the market surpasses the high number 3. In candle 5 we can see that price breaks high number 3, triggering a large amount of buy stop orders, and therefore, creating a deep liquidity pool that enables large traders to take the opposite position in the market, which in this case is the short side. You should be able to observe that this manipulation occurred simultaneously with news events, which serve the purpose to add fuel to the fire, but they don't change the rough dynamics of price. The three axes of our manipulation occur in candle 5. If you imagine the visual effect of candle 5 when it was trading near its high, you can imagine how this would represent the von Restorff effect and the reverse psychology portion of this market maneuver. When candle 5 was trading near its high, its apparent volatility was much higher than most candles in the chart, so that would give retail breakout traders a good amount of certainty. When candle 5 closed, most retail traders were already stopped out, and they started to realize that maybe they were wrong about the overall direction of the market. This is the reverse psychology maneuver being successfully employed. Immediately after the reverse psychology is realized, the bandwagon effect begins to take place, and the market starts to doubt the uptrend that began in number 0 as far as we can see. The difficult thing about this trade was the moment to open a sell position, because to derive that conclusion, you would have to be certain about the tridimensional axis of the manipulation you see on the chart. That would be the closest you would get to an objective tool to trigger the trade. This is why the market maker strategy can be difficult sometimes. You have to be confident about your ability to enter a trade based on your subjective interpretation of this tridimensional axis. The short position you see was opened right after candle number 5 precisely for the fact that the termination of candle 5 seemed to be the beginning of the bandwagon effect, which is the third and final axis of the manipulation. Since we have been going in an uptrend, and large traders apparently took the reverse position of long and retail breakout traders, it makes sense to open a short position with a stop above the high of candle 5. The rationale for that stop loss is that, if we are on the side of large traders for the downside, it is very unlikely that they are going to let the market go above the high of candle 5. For the target, we must respect the idea of expectancy and optimal risk-reward ratios, so our target should have between 1 to 3 and 1 to 4 risk-reward ratios. It's even better if this calculation coincides with a major point in price like we see here. Our target is 3.5 times larger than our stop, roughly speaking, and it coincides with low number 0, which seems to be a major point in the chart. Let's see how this market turns out. As you can clearly see here, the manipulation in number 5 acted as a tipping point for the market to reverse and trigger our target successfully.